European stocks are falling this morning as Spain's default risk continues to rise. So we're asking, what does it mean for stocks here in the U.S.? The answer may lie in the charts. One of InsideTrack's and Wall Street's favorite technical analysts is with us this morning, Ann Bartels, the head of technical and market analysis at Bank of America Merrill Lynch Research, with us to work her magic on the touch screen. And Ann, you've requested a chart here of the IBEX in Spain, been absolutely hammered, the stock market there, of Italy and the S&P. S&P in the yellow. Show us what this is telling us.
That's correct. The periphery has been hammered. So you have Spain actually here going to a new low, and we think Italy's right behind it. But we're seeing this divergence with the S&P where we're not continuing to go down with Europe. So that's a short-term positive for us. Another short-term positive that we have is that the market has been very oversold here. This is the
U.S. stock market.
This is the U.S. stock market. This is what we call a 14-day stochastic. It's a price momentum indicator, and it's very
hit the red.
There we go. It's very oversold. And the market is responding to this oversold by rallying, but we still have a temporary problem. We have a lot of resistance up here. So our sense is we can rally up near 1340, but we think we're going to have to come back down and test this level.
So what that indicator is telling you is we're set up for a rally, but don't expect anything hard, really strong.
That's correct. But we do believe later this summer we are going to have a strong summer rally. So the question is, what should we be buying as the market gives us this opportunity? And of course, we brought the answer with us today.
Mega caps.
Mega caps. And think of this as the S&P 100. And what we've seen, and this is relative to the S&P. So the mega caps have been declining, but this year, or actually starting in 2011 and this year, they're actually outperforming the S&P. This is what we call early leadership. And so we think that investors should be focused on this group of stocks. And fundamentally, what these stocks represent are great balance sheets, great cash flow. Many of them are yielding higher than the S&P 500 itself, higher than 10-year Treasury yields. And many of these companies are raising their dividend.
Okay, so mega caps set to break out. You saw it in the charts. U.S. stocks diverging from Spain and Italy. Good sign, and perhaps a little oversold. Come over here. I want to talk to you more about the markets, because you know, when we look in this sort of crisis time, you see a lot of correlation. You see stocks moving together with the dollar, with treasuries, this rush into the safe haven assets. How much is that going on, and how much is it going to influence what happens next?
Unfortunately, I think this correlation, particularly in down markets, is going to continue. So when markets go down, it seems that everything goes down. In fact, when we really study history before ETFs, there were only two items that actually outperformed: gold stocks and gold. And because so many investors today are invested in the gold stocks, they're not even providing the diversification that they historically have. So when you do asset allocation analysis, there's only two asset classes that are providing diversification: cash, which gives you no yield, and 10-year Treasury yields, which give you a little bit of yield.
Basically no yield. And that's why you like the mega caps.
Correct. We think that over time, you can get price appreciation. You can get paid to wait by having a dividend, and over time getting an increase in dividends. And we saw this behavior the last time the market was range bound, from 66 to 82. Investors actually walked away from the stock market. In fact, they should have been accumulating their wealth in the stock market. So we think investors are not really doing the right asset allocation strategy by walking away from equities. You can see the outflows in the mutual funds.
Absolutely. I mean, this has been the story. Retail investors spooked by what happened in 2007, 2008, 2009, the crisis, and they haven't really returned. Everyone was looking to the Facebook IPO to bring them back.
That's correct. And the last time in history we saw that was the last time the market was range bound. So our concern is investors are going to continue to walk away from the market. But what we're trying to do is encourage them and say, if you can have some patience, not go online every day and check your portfolio, that you can actually increase your asset, your wealth over time in these mega caps.
It's not just retail funds. I mean, we've looked at data here, and I know that you also study what hedge funds are doing. Macro hedge funds are having a tough time, too, with this headline-driven market dominated by macro events. I mean, checking the Greek polls every day.
Yeah, well, we're finding all asset classes are struggling. But we think if you can take a long-term view, invest in these mega caps, not turn over your portfolio, not turn over the portfolio, that if we learn the lessons from 66 to 82, we will eventually go back into a secular bull market, even though it may take a couple of years, but investors would have already been positioned for the new secular bull market.
All right, a message to retail investors: get off the sidelines. You saw the charts, S&P diverging from the IBEX, so don't be scared by Europe. Our thanks to Ann Bartels, Head of Technical and Market Analysis at Bank of America Merrill Lynch Global Research.